In the last video, we talked about the concept behind the balance sheet and how it's basically a list of accounts from our basic accounting equation. In this video, we're going to look at an actual sample balance sheet and try and get a better idea and feel for what it is. So if we look at the top of a balance sheet, I've chosen here, let's say that we have a restaurant. That's our business. This is Tom's Restaurant. It says balance sheet. And then we've got as of a specific date. Remember how important that is, that a balance sheet is a snapshot of the accounts at a certain point in time. If we could just take a picture of Tom's Restaurant as of December 31st, 2015, what would be the balances in the different accounts for assets and liabilities and equity? So I've got on the left-hand side, I've got assets, and on the right-hand side, I have liabilities and stockholders' equity. Just like our accounting equation, assets equal liabilities plus stockholders' equity. Now, I've chosen to put the assets on the left and the liabilities and stockholders' equity on the right, but if you look at an actual form in a firm's 10K filing, you might see where the firm has assets listed and then the liabilities and stockholders' equity come underneath after the assets. So you'd have like the assets, and then you'd have liabilities, and then equity listed like that. And that's really, it's not a violation of assets equals liabilities and equity or anything like that. That's just basically because it's difficult to put such a wide thing here on a sheet. When you're reporting, it's just easier to fit it all from top down. So that's the reason for that. But really, it's the same idea. I've got a wider screen, and I'm going to do it this way. So when we look at assets, it's typically broken out into two subcategories. We've got current assets, which are listed first, and then we've got non-current assets. I'm just going to scroll down a bit here so you can see. So non-current assets are basically everything that's not a current asset. So we got current assets, and then we've got down here are the non-current assets. Okay, current assets, I'll have another video on that. It's basically it's either cash or things that are expected to turn into cash or things that are expected to be used within the next year or the length of the operating cycle, whichever is longer. So let's just look at it as 1 year. These are kind of 1 year assets. Cash, for obvious reasons, it's cash right now. We've got some securities. We bought stock in another firm. Let's say we bought a little bit of stock, and so that's available for sale securities. And then we've got some accounts receivable. Accounts receivable is just basically if you've heard somebody in a bar say, put it on my tab, I'll pay you later. Well, that's what accounts receivable is. There's some customer out there who owes us money, so that account is receivable to us. We're going to receive cash from them at some point in the future. Then we've got inventory. We're a restaurant, so we have food. Right, we have food that we plan to sell, so that's our inventory, and then we've got some supplies that we use to prepare our food. But all these things are current assets right here. So those are our kind of 1 year, our 1 year assets that are going to be used or turned to cash in the next year. And then now when we get into the non-current assets, we've got things like long-term investments. Now I'll say for this firm, it doesn't have any long-term investments, but for another firm, this would be like you make a large investment, you purchase a large stake in another firm. You're not just buying a little bit of stock like available for sale securities, but you're taking a large position in another restaurant or something like that. But in this case, we're just going to say it's zero for Tom's Restaurant. And then the next kind of subcategory of non-current assets over here is called property, plant, and equipment. So property, plant, and equipment, we'd have things like machines, a work truck, and in this case, they're just going to have a building. That's the only property, plant, and equipment that we have listed. And then we've got intangible assets, which you wouldn't have a lot of for a restaurant, but you might for a technology firm. For our Tom's Restaurant, we're just going to say there's a trademark. So the trademark for Tom's Restaurant, the logo, whatever, we're going to say that that's an intangible asset. An intangible asset is just something that's kind of, you can't touch it, you can't really see it. It's a trademark, it's goodwill, it's a copyright, some kind of asset in that vein. So again, we've just got the current more liquid assets, and more liquid in the sense they're more easily converted to cash. And then we've got some of the longer term assets, things that aren't so easily converted to cash, like the trademark, the building, and then any long term assets. So we total all these up. So I just put in little little numbers here for each one of how many dollars they are. And of course, if it were an actual 10K you were looking at, there might be even subtotals in here of a subtotal of current assets, a subtotal of PP&E, which is property, plant, and equipment. That's, let's see, I'll just sneak that in there, PP&E. You'll see that often abbreviated. Maybe a subtotal if there's more than one intangible asset. But in this case, just for space, I just had them all listed right here, but just bear in mind you might see them subtotaled on a form. So ultimately, it gives us the total asset, right? That's what we want to look at, is total assets of this firm. The left-hand side equal the right-hand side. Okay, so but we're just breaking down. All these are asset accounts, right? Cash is an asset, PP&E is an asset. And now we turn over to the right-hand side of the balance sheet, and what we have are, we're going to have liabilities, which are here, and then we're going to have stockholders' equity. But since liabilities and stockholders' equity are both on the right-hand side, we're just going to list one on top and one on the bottom. So when we think about liabilities, let's just think about this piece first. When we think about liabilities, we can also kind of subdivide it further into current liabilities and then long-term liabilities, just like we can do with assets. And similarly, we can think of these being things that would be in 1 year or the operating cycle, whichever is longer. And in this case, we'll just say it's 1 year. So just say that these are obligations that we're going to have to satisfy in the next year. We're going to have to pay our accounts. So that's kind of the flip side of this. Hey, put it on my tab. Other people have extended it and given us a tab, and we owe them $60. That's what that is. And then salaries payable is just we owe our employees $25. We haven't paid them yet. And then we have some tax due. So all these things are due within the next year, right? That's what we call these current liabilities. So then we think of we got the second component, which is the long-term side of liabilities, which is usually a big amount you're going to have here is long-term debt, and we're going to have bonds. We'll just say bonds, or there's money that we owe the bank. Somehow we've borrowed money, and we're going to pay it back over the next 20 years. We borrowed money to finance our assets over here, and so that's how we started our business. We put some of our own money in, but we also borrowed some, so we owe $100, but we don't owe that within the next year. It's over the next 20 years, so we have this 100. And sometimes you'll see the current you'll have another account here called current portion of long-term debt. Current portion of long-term debt, and that'll be a current liability, and that's just saying that, okay, of the 100, how much is due this year? But in this case, I'm just going to assume that's zero, and we'll just say that you don't have to make any payments this year. But in the long run, you owe $100 to whoever it was that lent you the money. So we'll just call that bonds. And then, so we not only have the liabilities component of the right-hand side of the accounting equation in our balance sheet, but we also have the stockholders' equity, right? So stockholders' equity, we've got it broken out. We've got a few things here. We're going to say we have common stock, right? So now this is a little bit harder to understand. If we got a restaurant and it's just one owner, just somebody who started it. But if we think about a publicly traded firm, this is when firms actually buy stock, or when investors buy stock in a firm. It's actually going to be two components. And one is this common stock has to do with the par value of the stock. So in the old days, firms would have a par value that, well, I won't get into all the detail, but basically it would be a par value of $1 per share or something. And in these days, they set the par value really low, like 1 cent per share or something like that. But whenever a firm issues stock, it'll have some par value. And then the difference between whatever the firm sells the stock for and whatever the par value is, that's called additional paid-in capital, and that's that account right there. So basically, both of these accounts have to do with selling stock, or a firm issuing stock. So basically, we've got the par value of their stock, and then whatever they get in excess over par. And I'll have another video where we get into that, but this is just basically an equity issuance, stock issuance of the firm. And we'll say that for Tom's Restaurant, it's $50 of common stock, and then zero in terms of additional paid-in capital. And then another part of equity that we'll commonly see is retained earnings. Sometimes the firm doesn't have any retained earnings. Remember that retained earnings are mainly driven by net income and dividends. So basically these are profits that the firm has chosen to retain over time. So if it's a firm that's a startup, they might not have any profits yet, but we'll say that Tom's Restaurant has $15 in retained earnings. Now, again, like our left-hand side, we can have subtotals, right? Among all these totals, we can say, okay, well, what's the subtotal of current liabilities, right? And we can have what's the subtotal of just liabilities in general. We can say what are the liabilities, what are the, can't spell there, that's terrible, I apologize. What are the liabilities, what is the stockholders equity account, and then, but just in the interest of space, I have the bottom line, which is the total liabilities and equity, right? Now, total liabilities and equity, we add up all these numbers and it comes out to 280. Now, again, as we talked about before, it's very important that the stockholders equity and liabilities be equal to the assets. In other words, we need to make sure that our balance sheet balances.